Okay.
Okay, welcome everybody. Thanks for everybody for accommodating our unusual start time. We don't usually start, as you know, at 7:30. Today we decided to have a discussion on the distressed debt market, and a lot of the people are on trading desks and the like, and really did not feel comfortable doing the call from the middle of the trading floor. So appreciate all of their time, appreciate everyone else's accommodation. We have been getting wonderful registration for these events. So thank you, and hopefully good attendance here as well. Today, what we thought we would do is have one of the speakers from Cy Sims, who's actually a professor in the finance department, who's had experience in distressed debt and other matters through his career. Maybe give some little bit of background. These again are, of course, YU continuing education events. We have highlighted people from the community and the professional community who are actively involved in different aspects, and we'll introduce them in a second. But first, I'd like to introduce Professor Avram Ravid, who will go ahead and kick us off on our discussion today about distressed debt. So I leave it to you.
Hi, thank you very much, everybody, for coming. Thank you for asking me to address this group. So let me introduce myself and my work in 2 minutes or less, as I was asked. I hold the Cy Sims Chair in Finance in the Cy Sims School of Business, and I'm also the chair of the Finance Department. Before coming to Yeshiva, I taught at the University of Chicago, at Yale, Cornell, Wharton, UCLA, Columbia, NYU, and for a long time at Rutgers. And my focus in teaching and research has been corporate finance, fixed income, and the media industries. Some of my most cited papers are on debt maturity, trade credit, and I've done work on comparative bankruptcy codes and deep dives into how seniority matters in debt in the context of bankruptcy, which is very related to tonight's topic. I've taught fixed income courses for 3 decades at Columbia, NYU, Rutgers, Cornell, and I actually initiated it at Yeshiva University. Today's topic is distressed debt, and incidentally, that's what we talked about in class this week, in particular about research that shows that weak companies tend to do even worse during crisis, where sound companies can survive. And in the current crisis, an initial spike in yields, as you all know, in the junk bond markets has by now calmed down dramatically, reaching a historic low and a normal spread a couple of days ago. And I generally believe in the predictive power of markets, except with the exception of December 2008. Those of you who are around know what I'm talking about. I believe there are opportunities in the distressed debt markets, which I'm sure you'll discuss tonight. And there are companies that are worth more alive than dead. And a seat at the table and reorganization can be a significant value driver. I told to cap my remarks in 2 minutes. I'll stop here. I'll be delighted to answer questions now or via email about what we're doing at Sims, my research, or connect you with our able students. And I would welcome any alumni who are interested in talking to them. I'm actually hosting 2 industry guests in my classes, one of them a YU graduate in the coming weeks. So I would welcome more. And I would welcome any connection with the students, with our faculty. And thank you very much for listening. And I take the discussion back to Lawrence.
Thanks so much. That was great. School's changed a lot since I was there 30 some odd years ago, and school's really been hiring some great professors. So great to hear some of the coursework that you're involved in. Tonight's discussion on the current market for distressed debt is in a way a catch up from the last discussion we did 2 years ago. 2 years ago, we had a great in-person panel that Andrew Herenstein at Monarch was able to assemble. Really a remarkable discussion 10 years after the financial crisis. So as Professor Ravid was saying, the 2008 crisis, we decided to do a 10-year recap. The market's been funny and crazy the last year. It's been a little bit of a binary dynamic. There's certain sectors that have been hit quite badly because of COVID. I'm a telecom investment banker. For the most part, my life has been fantastic. We're all doing Zoom because of my clients and a lot of things that I'm involved in. But there are a lot of sectors that are not. And we thought it'd be great to have a discussion about the topic. And I was brainstorming with Josh Joseph about it. And he said, yeah, we've got a lot of great people, actually YU grads who are involved in this. And maybe we can add some other people with a background in law and talk about some of the bankruptcy trends that they're seeing. So really want to thank everybody on the panel who are coming here today. I think people see it on the invitation. You can click on the actual bios. This is pretty unusual for us. We have 3 people who are graduates from YU on the panel. Josh Joseph from Sims, class of 2012, who's at Black Diamond. Simon Brookim, class of 2011, who's at Centerbridge. And Matt Rahmani, who's a class of 09 at Perella Weinberg. So pretty unusual for us to have so many people. People who are coming over here. Not everybody is a YU alum. The office is run out of the YU Office of Alumni Affairs. We're going to hear from Eliza Abrams at the end from YU Alumni Affairs, but everyone's welcome to participate. And of course, we're very happy to have non-YU alum as well. Ian Glastein, who's also, I guess, at Monarch. Hopefully, Andrew is okay with your speaking here late tonight and not working. And Josh Brody from Jones Day. Of course, thank you so much for participating. We're all looking very much forward to hearing about what's going on in the markets today. So Josh, I hand it off to you.
Thanks, Lawrence. And thank you to Lawrence, Eliza, the whole YU team. I know I've always found that the YU alumni network in finance and Wall Street has been particularly helpful. So I appreciate that. And I appreciate also kind of being a part of it. As Lawrence mentioned, I think we have a great group of people here tonight. Panelists from both the buy side, the asset management kind of side of the distressed world, as well as a restructuring and bankruptcy counsel. So I think we'll get to hear a little bit from everyone's perspective. I thought I'd give an overview, a couple minutes just on the distressed world kind of today, and then we'll jump into some questions for the panelists to dive in a little bit deeper. So just for some background, I know probably most people on this call know what distressed debt is and kind of appreciate the markets, but just a quick background. When we talk about distressed debt, we're referring to tradable debt of corporations that are experiencing some type of kind of operational or other challenges or stresses, and that's probably caused their earnings and balance sheet to weaken, and therefore the debt that's traded to the market has traded at a material discount to par. Today, I think there are a couple different conflicting factors at play, which are causing the market for distressed debt to be somewhat difficult for an opportunity set, but also has the potential to be very active and robust over the next kind of 6 to 12 months. So just to quantify it, per DebtWire, the amount of US borrowers with bonds considered kind of distressed that are trading maybe below 80 cents in the dollar was 150 prior to COVID. And then just through March and April, doubled to 300. So 300 bond issuers with debt trading at material discounts to par and considered kind of distressed and in trouble. Obviously, that was due to the global shutdown, many industries shutting their doors for months, leisure, travel, transportation type of industries being materially affected. And for context on the borrowing rates and how rates have changed, the average rate on a high yield junk bond, as we call it, pre-COVID was about 6%. It jumped to 12% in March. And then, kind of interestingly, over the next 3 months or so, though that same number of distressed bond issuers went from 300 to 200, and the average yield on a junk bond went from 12 back to 6%. So it's pretty shocking. Turn of events just really through kind of June, July, given the real risks and uncertainties surrounding the economy, unemployment, fundamental challenges around companies' balance sheets, et cetera. And That said, there's real catalysts at play, and we all know the Fed has provided a lot of stimulus, helping the U.S. economy and the U.S. corporations. Some stressed companies have come to the debt capital markets for rescue type of financing that has been able to shore up liquidity for them in these very difficult times. Some of them have their doors closed still, where they've been able to kind of gain access to liquidity and capital that can give them breathing room for the next 12 to 24 months in some of the cases I've seen in the industries I cover. And then, a lot of companies, which I found pretty interesting, specifically in the gaming space, in the casino space that I cover, a lot of companies, directors and C-suite kind of took the 2 to 3 months where they were just shut, and they really took the time to kind of streamline expenses, offload personnel, discontinue unprofitable kind of operations, which has helped their margins. So I guess all in all, I guess what I'm trying to say is there's a lot of factors at play, a couple of different disconnects, which is making it very interesting. And the last thing I'd point out, just from a distressed asset management perspective, on average, distressed funds, asset managers that raise distressed capital have raised between 10 and $40 billion a year from 06 to 2019. And in 2020, thus far, over $100 billion has been raised. So there's obviously a lot of interesting dynamics in play and a lot of capital that the distressed world believes will be able to put to good use. So I think that's just kind of a quick overview. And I'd like to dive in with our panelists. So just starting with our buy-side panelists from the asset management and hedge fund kind of world. So Ian, maybe if I can start with you. If you can just help us, describe what your current focus and strategy is with respect to looking for distressed opportunities today, any themes, any sectors that you're trying to focus on and spend time on.
Yeah, absolutely. Thanks, Josh. So I'd say, it's pretty obvious, but COVID has really impacted the market. And so first and foremost, where we've been looking is industries that have been impacted by COVID. And so you could think about real estate, healthcare, transports, leisure, entertainment, restaurants, retail, autos, some energy, have all been very active for us, and they've been fruitful places for us to look at opportunities. Sorry?
Sorry about that. Sorry.
Okay. I'd say the second industry, or the second theme that we've been focused on, have been industries that I'd say were previously redlined pre-COVID and continue to be redlined. And these, for the most part, have really been left for dead. And so we're finding opportunities, in some industries, retail being one, some industries that were, I'd say, cyclically challenged pre-COVID, where we expect on the back of COVID for there to be a very strong cyclical recovery. And that will lead, potentially to a snapback in demand against a backdrop of, much more limited supply. Hotels would be, one industry that fits into that category. And then the third, is sort of a piece of our business, which is continually, producing opportunities, which is just off the run opportunities that we are able to source through our network, are just generally underfollowed. And to the extent that, we can invest in things that, others aren't focused on, we generally find that a pretty interesting place to, to be looking for new investments.
Okay, great. Just moving to Simon, who as well joins us, and myself and Ian on the buy side. Simon, what are you focusing on? Any strategies that you think are particularly interesting during kind of this COVID world?
Sure. Thanks, Josh. So when we look to invest in distressed opportunities these days, we try to take a differentiated approach to many investors. So for example, I think when most people investing in the distressed markets today, they're usually experts on the right side of the balance sheet. And they tend to spend the majority of their time focusing on the fulcrum security, thinking about building a blocking position and finding loopholes within the debt documents. And we agree those are important areas of the analysis, but we are very focused on the left side of the balance sheet, because you really need to have a deep understanding of the underlying fundamentals of the business. And you need to be ready to dive into a situation as if you're going to be the owner of the business coming out. And that is something that we've realized that many investors in the distressed markets today, deeply lose sight of. And so when you look at the credit markets today, as was pointed out earlier, we've seen a significant rally with the yields and junk bonds trading at record lows. I think it's about yielding about 4.5% today, which really limits the opportunity set, especially in the public markets. And since we're not a trading oriented firm, what we've been trying to do is trying to manufacture opportunities where we can control our own destiny instead of essentially relying on the public markets to eventually understand that something is overpriced or underpriced. So our focus has recently been less so in the public markets, but more so on opportunistic investments, such as like rescue financings, where we can essentially partner with good companies and good management teams who have likely been hard hit by COVID and are facing significant liquidity challenges. And since these companies can't raise liquidity in the traditional capital markets, there tends to be an attractive opportunity for us to step in and provide flexible and highly structured financings at favorable rates.
Great, thanks. It really is interesting. I feel like a lot of what we've just discussed thus far with Ian and Simon is trying to make our way to find a nice risk reward and a nice yield in these type of investments. And it's kind of what you would have thought to speak about pre-COVID, not when we have major distress and anxiety in the economy, but that's really kind of the kind of world we're in, is where you have to find very interesting and new special situations to really invest your kind of investors' capital. Just moving, I thought I'd move to Matt, who is on the restructuring side, who kind of advises and represents a lot of us and other lenders throughout the space and companies throughout the space. Matt, any sectors that you're tracking that you believe are facing some levels of stress, and kind of how are you focusing your time and effort these days?
Yeah, sure. So I think much like Simon and Ian mentioned, to a certain extent, it's very easy to get the low-hanging fruit, and so impacted businesses that are immediately impacted by COVID. And so, as I think we kind of look at the market from a restructuring opportunity sense, I always say I think my job is a lot easier than Simon's and Ian's, because we're all looking at garbage, but they have to decide what's really not garbage. I just have to identify the garbage. And so, in that sense, it's very easy to see all the companies that need liquidity, that are structurally impacted by COVID. As an example, the industries that I've worked on live deals this year are offshore, oil and gas, travel and leisure, metals and mining, and consumer goods. And I would say half of those companies were probably situations that we're going to restructure anyways, whether it was this year or next year. And maybe half of those were actually COVID-19 directly impacted businesses, in the sense that they were the zero revenue businesses. And so we bifurcated based on, okay, what are the companies that are directly COVID-19 related, and where are those opportunities? And then I think more broadly, it's not necessarily about which sectors per se. Historically, obviously, retail and energy has been more than enough for the restructuring advisors to work on, just hundreds of issuers who just categorically needed to restructure. And so that has kind of put food on the table, if you will, for restructuring bankers for some time. I don't really think there's an industry like retail or like energy where we're going to have hundreds of issuers that are going to fall into distress, and it's going to be that easy. But what I've been trying to identify are, what are the broader themes and subsectors that are being impacted within broader sectors. So, as an example, technologies is an industry that generally people don't think about in the context of distress. And broadly, I think technology probably impacted from COVID. But on-premise technology or companies that provide tech and infrastructure on site clearly are going to be impacted as people spend less time in office and companies think about their real estate footprint. So there are companies, I think, in that vein where perhaps buy-side individuals haven't focused on. I think for myself, selfishly, perhaps restructuring bankers haven't focused on. And so I found maybe sometimes I can, be the first to an opportunity, on that front. Some other examples could just be, CPG broadly is changing, but not enough to cause just distress across all food and beverage, but the printing and packaging for CPG goods, I think are being impacted, right? Restaurant and retail, a restaurant is changing, but not maybe as just broadly across the sector, but glass usage in restaurants are changing. And so thinking about the subsectors within those broader, the broader themes within the larger sectors, to date, I think has been fruitful, and probably across the buy side and sell side is something to focus on.
Okay, thanks. And yeah, I happen to agree. Part of my coverage is on technology side, and the on-premise is definitely shifting pretty rapidly. Just to kind of close off among all the different perspectives, Josh, Brody, I thought maybe if you can provide kind of your perspective on the distressed world today, as you represent a lot of debtors and creditors, any specific dynamics that you think are particularly interesting that you're seeing as restructurings, Chapter 11s kind of occur the last couple of months?
Sure, thanks, Josh. As a couple of different things, I think the one that's probably the most on everyone's mind is what has been characterized, I think, as lender-on-lender violence. And what I think actually fits really well with a lot of folks have been talking about in terms of finding distressed opportunities has been a little bit hard to come by. And so one place that a lot of funds, I think, have been looking for returns has basically been to pick the pockets of other lenders that are otherwise in their same, asset group. Once upon a time, I don't want to date myself too much, if you were in a particular class of debt, you generally as everyone else who held that kind of debt. But over time, what's happened is I think that people have been looking for opportunities, and one of the ways they've been finding those opportunities is in trying to take advantage of I call them loopholes, but the status of debt docs, it offers opportunities to a bare majority of lenders to provide capital to a company and basically come ahead of a lot of other lenders in the group. And so that's one area where there's been a lot of activity on that, and it's been a lot of litigation. And the interesting thing is the loopholes that I think a lot of these creditors are trying to take advantage of are not new. Right? It's not like this is a new trend, like someone became Cov Light, and all of a sudden people saying, hey, we can do this. It's more of a these are doc provisions and credit agreements that have existed for years, and it's only recently I think that people have really been trying to take significant advantage of it. So it's gotten to a point where funds have to not just think about the fundamentals of the investment, but they have to see about what actual bigger position they have. And I've had this happen with clients and friends of mine who were at big funds, went to smaller shops, and suddenly realized that because they couldn't take on a big enough position, they were getting blocked out by other bigger lenders in the in their class. And that's something that's become a very big topic and a big issue, I think, in certainly recent months.
It is very interesting. I agree. We've seen some of those deals across our desks, my desk as well. Josh, do you think that's largely due to the lack of yield and just lenders have to find certain ways to kind of hit their returns? And if that happens to be with kind of the violence or the lender on lender kind of more proactive approach, and that's really kind of what's occurring today. Did you see that in 08-09 as well, or this is pretty COVID specific?
I don't think it's COVID specific. I think it's more a function of just the current state of the market. But I think there's a couple different things that have led to this. Number one is, in part, it's funny. Once upon a time, this thing was just viewed as sort of like not gentlemanly, to put it that way. It's something that people just wouldn't do. And over time, it became more acceptable. I mean, just as one example, I don't know how already it's about 4 or 5 years ago. I was doing some work for a couple of funds which shall remain nameless in a company called Peabody, and we did a pretty oppressive rights offering in a very, very short time frame that folks who were not bondholders who were not sort of on the inside got hit pretty hard, and people went crazy. I was getting calls from clients not involved, who were just yelling at me that they're about what was happening. And at the time, the funds that were doing it, I think, were viewed as more on the more aggressive end. But over time, I think that's become a little bit more sort of the normal course. So it's a combination of funds needing a place to find returns, you have funds, it's more willing, people more willing to do it. I mean, heck, up until recently, the CLOs were the ones who were usually getting their pockets picked on this sort of thing because they didn't have the ability to actually do these things themselves in terms of what their organizational documents provided. And now you saw this happen with, with CERTA, where the CLOs were actually, sort of taking swipes at the bigger hedge funds, turning their own game around on them. So it's become something that's just become acceptable, and people see as an opportunity, a way to find returns. I think you put all those things together, and it's just something now you have to, I think, take into calculus when you're looking at any distressed opportunity.
Definitely, I think there's been enough articles and kind of headlines made about sort of transaction and a bunch of others as well. We mentioned the kind of very quick bounce back in loan and bond prices over the last couple of months. I'll bring it back to Ian. Ian, kind of what's your view on some of the sectors that I guess maybe should have been hit harder because of COVID, and they're probably in the eye of the storm, but haven't and have bounced back? Kind of what's your view on whether you see another leg down in the market, over the next couple of months or so?
Sure. So I think ultimately, in the current backdrop, what we're seeing at least is a very supportive Fed, especially post-election, a real reduction in volatility. You have a ton of liquidity in the market, and you have, a very significant amount of dry powder on the sidelines, both in terms of private credit and private equity, and frankly, bank liquidity. And so there's going to be a tremendous amount of support for companies that should survive. That being said, companies that came into COVID with a significant amount of leverage, and there were a lot of them, without seeing a strong cyclical recovery here or further government support, these companies will likely need to restructure. And if these companies need to restructure, there will be sellers of that debt, and there will be opportunities, on the distress side. You can also see it, from a macro perspective, to the extent that either further government support is delayed, or there doesn't materialize. To the extent we go back into lockdowns, to the extent that unemployment is sticky at these levels, or even picks up again, you could definitely see consumer spending under further pressure. And so we do see the possibility that there will be weakness from a more macro perspective, but there is just a tremendous amount of liquidity out there. And so you may get companies that in a normal environment, let's say pre-COVID environment or pre-QE environment, that would definitively have restructured, sort of muddle through here. In which case it's our opportunity set's going to be limited to the companies that that are having more severe issues.
Got it. Yeah, it's interesting with the rescue financing you mentioned. Like, I guess from a debt perspective, when they're raising debt, I'm not as surprised. But from that of equity rescue financing that we're seeing kind of like in the leisure space, and the cruise lines, and Carnival keeps issuing equity, and RCL, and a bunch of others, I'm just kind of shocked. I know there was the Hertz kind of headline fiasco probably a couple months ago, but it is really interesting how the equity markets are also providing some type of liquidity when they're behind so many tranches and layers of debt ahead of them.
Yeah, I think one interesting thing you saw over the last few weeks, AMC, the theater company, had bank debt trading in the 50s and 60s, issued close to $100 million of equity, at the really at the market to retail investors for the most part. And to be issuing equity when your senior most debt is trading at significantly discounted prices was very shocking. Now that looked silly in retrospect. We were laughing about it, but on the back of the Pfizer vaccine news, that equity more than doubled. And so maybe we're the ones that should have been buying that equity, as opposed to looking and wondering who could be buying so far out of the money equity in this environment.
I think it's the Robinhood guys, isn't it? I think that's kind of that's what I always thought. Who's buying the Hertz and AMC equity?
Should ask Simon.
Simon, what do you think about? Sorry.
Yeah, we're definitely the buyers of AMC equity.
Simon, kind of what's your view, and how are you guys thinking about this huge rally, and whether we'll see another leg down, and if and when that will happen? Likely will happen, but how are you guys looking at it over the next 3 to 6 months?
Sure. I think just to add to Ian's point, I think we have seen a lot of companies raise a significant amount of debt post-COVID. And while the near-term liquidity for these companies has improved and has helped them to survive, we think a lot of these companies will be too leveraged, which is going to create a ton of orphaned and zombie capital structures. And because these companies won't have much flexibility going forward, they're going to have too much debt, they're going to have too much cash interest, and they're not going to have the EBITDA and cash flow to support it. So we expect a lot of these companies, especially those that are operating in more secularly challenged businesses, that these companies are going to be filing over the near to medium term, which leads us to be more patient, since we expect to see more bankruptcies coming along. I think one of the things that many people think about in terms of the distressed opportunity set, I'd say, is that many tend to focus on the major distressed markets that we see every 7 to 10 years and wondering, was this the once a decade distressed opportunity, and have we missed it? But what I also want to point out here is that we've been experiencing very sharp and short-lived corrections in the credit markets every 1 to 2 years, roughly, as we saw last in December of 2018 when rates started to increase, and then again in February of 2016 with China, and then again in August of 15 with oil prices. And these are all different reasons that shock the system, and these catalysts are pretty hard to predict, but these opportunities tend to be intense and somewhat short-lived in nature. And we think a critical advantage for investing in these distressed markets today is having more of a drawdown fund structure, which is similar to a private equity fund structure and locks up capital over many years. So you can really take advantage of these idiosyncratic opportunities, which tend to be fairly short-lived, that we see occur every 1 to 2 years, outside of the larger distress cycles that we see every decade or so.
Thanks. Yeah. Thanks, Simon. Appreciate that. Matt, as we're kind of talking about different opportunities and how to kind of make our way around this COVID investing environment, what are you seeing as you get hired by either lenders? I guess specific lenders. I was going to say lenders and the company, but when you get hired by lenders, what are you seeing in terms of strategies that they are thinking about? Kind of the first blush when you're in a distressed scenario, you have this company that's probably burning a lot of cash flow. Any specific strategies or themes that the lenders come to you guys to help with to kind of fix the balance sheet or to fix the operations, cutting costs? What kind of themes are you seeing in terms of how to really fix an operationally very difficult environment?
So I think by the time that we probably are hired by lenders, it's something probably more acute. I think in general, credit funds are probably loath to hire an advisor specifically on the financial side, unless there's something to do. And so a lot of times that'll either be because the company specifically told a lawyer or a top holder, what you should advise her up. Or if it's very clear that something is coming, or if it's clear that you're afraid that something may be coming. But for the most part, we're getting hired with the intent to do something very specific. That could be to negotiate around the deal. That could be to try to propose something proactively because something is probably going to come anyways, or it is to shepherd a class because like a hard Chapter 11, a hard restructuring is coming. I think to answer the question more pointedly, I would say the comment that Josh mentioned earlier about lender on lender civil war, if you will, happening in the industry right now. I think every group that I've represented over the past year, automatically the first question is, well, what can someone do around me? And who's in the group that might actually not be in the group? And so there's a lot of one-off conversations that are happening with one-off individual clients and groups that, despite there being an actual group, I think there's a perspective of that we have to find a way to stay together. In one of my situations, because of that, the group essentially fell apart. In another situation, everyone signed a co-op agreement so that that wouldn't occur. And in another situation in which I'm on now, people definitely feel like they're looking over their shoulder. To kind of comment on Josh's earlier comment too, that's not to say that there's no collateral damage from this. I spoke with a lawyer yesterday who was iced out from pitching an opportunity because he's representing someone in another situation that boxed out that creditor. And then, I'm working with a client now who refuses to admit someone into their group because they're on the other side of them on a different situation. So Josh mentioned it, but I actually really do think that is pervasive through the creditor side mandates now. And so there's a perspective of, if it used to be, what is the sponsor going to do? But now it's what are lenders going to do? And so it's really become more of a like credit activism, type role, where we right away we're trying to think about the options that the group has and how quick we can execute that option before someone else does effectively.
Right. No, that does tie into kind of what Josh was mentioning as well. So Josh, as when you do get hired by lenders and by ad hoc groups, you mentioned a lot of the lender on lender kind of issues and kind of constraints. I guess the back and forth that they represent. Anything with the company or with the sponsor, is there any fear about what sponsors may do, or is it really ad hoc versus ad hoc group, or first versus second lien with respect to bankruptcies?
The answer is that it's both, right? I mean, at the end of the day, a lot of it depends on the dynamics of the particular situation. And, you can have a situation where, you've got a private equity sponsor at the top, you've got the company, and then you've got a couple different classes of lenders, and you got to worry about who's teaming up with who to squeeze, who's going to squeeze out who. And so it does, to Matt's point, I mean, you really do have to be a little bit, I don't know if paranoid is the right word, but concerned about everyone else around you in the credit and how they're thinking about things and who's trying to put deals together. Now, some of this is not necessarily new, right? It's not new that you may have a class of unsecured creditors is going to try to get together with the company to basically, cram up the secureds, right? That's been going on for a long time. But the idea that you have to be more careful about not just other creditors, but even creditors within your class, especially pre-bankruptcy, it becomes a real problem. I mean, look, the reality is that, and it's kind of funny, I think, in some respects to say it this way, but relationships have become a lot more important now, because sometimes it's just a question of knowing the right other folks who you can circle up and to get them together and actually see what's going to happen. And to Matt's point, sometimes used to be that I was representing an ad hoc group. If someone wanted to join, like for the rest of the group to not let them in, it had to be something really, really specific why you wouldn't want to let a particular fund in. Nowadays, it's a little more, almost cliquey. I feel like I'm back in high school sometimes, right? But the reality is that's just, people are much more concerned about what's going on in the credit or in other credits and who else is willing to try to pick their pocket. They're a little more particular about who they're willing to work with. But the funny thing is, like, I find these cooperation agreements personally sometimes to be almost, I'm not going to say silly. I know the point. I get the point of them. But sometimes they actually really work. The lockup that you have to impose on people in order for a cooperation agreement to really have teeth and prevent people from doing something that you don't want them to do. I mean, to me, a lot of this is more about reputation than anything else, because most of these cooperation agreements, notwithstanding, I think the LSTA wants to standardize them. For the most part, I think these cooperation agreements sometimes are really just more about people, basically putting down their marker, saying, okay, gentlemen's agreement, we're not going to screw each other.
And you mentioned that it's not only the kind of distressed hedge funds, the more proactive funds that are potentially doing this, could be the CLOs too, right? Or just, maybe they have size, right? They have size.
Yeah, they have size, and they've realized that if they're not proactive, they were the ones who were having the problem. I mean, I've seen this already been going on for a while. I mean, there were a couple of years ago doing a deal. They had a couple of CLOs in the group, and there was no intent on anyone's part to pick their pocket, but it just got to a point that if you didn't put up new money, the deal just wasn't going to work. And some of those CLOs, it wasn't something they could do because they couldn't get the rating that they needed. And it wasn't, additional capital they could put up. And so that's kind of, to morph them like that has become a strategy, but it's, it's not, in terms of it's not new. The CLOs have realized they have to get there. I mean, heck, even some of the, big mutual funds who have historically not been, you looked at them about ways to squeeze value out of other creditors' pockets. They look at you like you're crazy. Now they're realizing that they need to actually do that in order to be able to continue showing returns.
Yeah, and I've experienced something that you and Matt were talking about in a larger name, where really the first priority among all the lenders that got together when we knew there was going to be a covenant breach, it was kind of let's stick together and be as large a group as possible, so that there isn't some kind of faction that just kind of splinters off and ends up screwing up the whole potential restructuring, the whole potential deal, and it actually did come to fruition, although I know it's not always so likely that it happens and occurs.
And also, the funny thing is, right, there's a sweet spot where you have to, in terms of size, where you have to be, right? Because you basically need more than 50% in order to make any changes to the document. But if you're at 90%, there's only a limited amount of juice that you can get. So you got to be in that right area where you can, basically make changes to the documents because you have a majority, but there's enough of a minority left behind that you can actually squeeze some value out of it.
Definitely. I wanted to kind of shift a little bit away from the lender to sponsor dynamics, just thinking about kind of underwriting credit today. I find it interesting in my day-to-day that, we always look at kind of what this company can do over the next 12 months. And now it's kind of, what's this, I have to model out 12, 24, 36 months for some of these companies to really figure out what kind of a run rate, cash flow run rate EBITDA is, and run rate kind of, creation point is. Ian, what are you finding interesting kind of or different about kind of underwriting standards and how you guys have to underwrite companies and credits nowadays?
Yeah, it's a really good question. And so I'd say first and foremost, it sort of depends where in the capital structure you're investing. And so to the extent you're investing in the fulcrum, you need to be much sharper and probably, to a certain extent, much more aware of the downside scenarios. And so, when it comes to COVID impacted names, the cadence of the recovery, the slope, of the recovery, the timing of a vaccine, the timing of whatever it is, return to, normal life, return to the office, return to school, all of that is, all of that's really important. To the extent that you're investing really at the top of the capital structure, and it is more of a credit investment as opposed to an equity investment, or an equity, a credit investment dressed up like an equity investment. You could be, I think a little bit, less sure about, the cadence of a recovery, because in general, at that point you'd be solving for debt-like returns. There's, almost no scenario where you would be the fulcrum, and you always have the opportunity for those below you in the capital structure to be putting up new capital. And so it's definitely tough. Obviously, nobody really underwrote a global pandemic, in 2019, and it has become really difficult for people to underwrite, the recovery from the pandemic and the return to normal. One of the things that we like in this environment, though, is, people tend to talk in absolutes. Nobody's going back to the office again. Nobody's going to stay at a hotel again. And so those are really, really interesting spots where, you don't need to assume or underwrite that much of a recovery to find value in this environment, because, people have given up on certain industries. You see it in, I said, hospitality, you see it in retail, you see it in energy, you see it in gyms, and to the extent that you could just take the other side of the never trade, even with, more conservative underwriting or a less clear picture of the future, we've been able to find value.
Yeah, I think it's a really good point. People just kind of write off and say this is a zero business, and when there's almost, not every situation, but almost always there is some value left to the capital structure. It's some way out, some way of kind of creating value, and or either value through the debt or value through the equity. Simon, any kind of industries on this topic that are maybe down in the dumps today that you think people should focus on as potential recovery? Any kind of ideas of what may see a pretty surprise turn to the upside?
Sure. I think in terms of industries to the upside, I think one area that we've seen significant demand is in the telecom space, where we've seen a lot of these infrastructure funds who view some of these assets as utilities and willing to pay significant premiums to where distressed creditors think these assets are worth. So we're seeing a real diversion of value in this space. And so we think there's some opportunities there. We've also been spending some time on some of the travel related industries, such as like the GDSs, which really don't take pricing risk. It's more of a volume risk. So when you see some of the travel come back, is there an opportunity there for some of these players, as well as some of the event production companies that help when you think about some of these conferences. We've been spending some time on those sort of companies in terms of just better understanding the value proposition for these companies going forward. And while you're looking at the high yield market today, just reaching record yields with roughly 4.5%, I think what we've seen mostly on the long side are more idiosyncratic opportunities. And we think there are actually some risk to downside across many sectors as we're near tights today. So when you're thinking about industries like retail or like theaters or paper or even parts of media now, which are all industries facing secular challenges, we believe like recessions, and especially with what we've seen from COVID, it's further going to accelerate these secular decliners, and these businesses may never come back. I think the issue you're facing by investing in some of these secular decliners is answering a question that we internally struggle with a lot, which is a question is how cheap is cheap enough? And because you can, even if you're right on the creative where you're creating this business at today, if you don't have a plan around the exit well thought out ahead of time, you're not going to get anywhere near the return profile you had modeled out. And I think even within these industries, you should expect to see further downside from these companies that will need to tap the capital markets for additional liquidity or looking to refinance the upcoming maturities, because the capital markets tend to shy away from some of these more secularly challenged businesses. And I think just to briefly touch on some of these industries, if you take a look at retail has been a pretty cyclical sector. I think with COVID, it's really accelerated the challenges that you're seeing in brick and mortar retail, which makes it very hard for us as a firm to get involved in this space. Because even if you fix the capital structure, we don't think it ever solves the issue, and we don't want to end up owning illiquid reorg equity in a declining business. And then if you look at, for example, the commercial real estate market, there's been a ton of amend and pretend going on in this space, and lots of headlines around REITs buying companies like JCPenney just to avoid co-tenancy clauses. And our view is that these are just band-aids, and this is just going to create more stress and distress opportunities in these sectors going forward. And I think even in media, we're seeing content value chain rapidly change. And you need to do here is you need to essentially be able to control that content, but also reach the end customer. As a result, I think the middlemen here within the value chain are going to continue to see the margins get squeezed. And because the revenue will continue to decline, since their customers are largely tied to the MVPDs who are facing pressure from cord cutting. And on the other hand, they're not only are their top line declining, but their costs are going to increase because content suppliers are going to increase their costs due to the pricing power they've received as big tech has started to bid on some of these content deals. So we think there's an interesting dynamic both from the long side as well as the short side across many industries going forward, and hopefully presents an attractive opportunity for us to invest.
Yeah, it is interesting, and there's a lot of different industries and kind of moving pieces to think about in that vein. Kind of one question I wanted to just kind of talk through and hear everyone's opinions on is, Ian mentioned it, is a vaccine, and obviously big news with Pfizer on Monday, kind of helped a lot of the leisure, transportation, really COVID heavy names rally a ton. I think the AMC loans were up 15 points and the bonds probably as well. And then we saw the equity as just one example. I know, at Black Diamond, we discuss a vaccine, we discuss, how COVID is going to shake out, and no one really ultimately knows. And I think it's interesting to think about is, I guess, what is your view? And I can move to Matt, and just kind of how you think about when you're pitching and talking to potential lender groups. What is kind of your view, and how do you think about COVID, and whether, and when a vaccine will occur, and if that even matters, and how much does that go into kind of your pitches to opportunity sets with, is a vaccine going to come? When is it going to come? And then does it ultimately matter? Do you have to kind of model around it?
Yeah. So obviously, we're talking about really the companies that are directly COVID impacted. And so for those companies that are directly COVID impacted, the question is, what was their catalyst? So why am I involved in that situation, right? And so if you bifurcate it into two different profiles, one are capital structures that had near dated maturities, and maybe pre-COVID, they would have been refinanceable. And now we're at the point, in this post-COVID world where there's so much uncertainty, and therefore the capital structure is not refinanceable. So in that way, I think you really do start to have a question of, does that vaccine news really, does it place that capital structure in a position where you may be more inclined to refinance it, or you may be more inclined to agree to an amend and extend, because you actually see the other side of it. A lot of the companies that are COVID-19 related, though, that we've been helping with are liquidity-based issues, right? And so they're companies that they're in a zero revenue environment, and they don't really have capital structure maturities. But why we got involved is because the company was running out of cash. And so either on the company side or on the creditor side, we knew that there was going to be a liquidity need. So do I think that announcement of a vaccine is suddenly going to help a zero revenue company generate cash to avoid a liquidity catalyst? No, I don't think so, because not only does the vaccine have to prove effective, not only does it need a distribution model, it also needs everybody to then, sign up to take the vaccine. You then need to have people comfortable with the fact that the vaccine is working. You need to have people comfortable with the fact that the vaccine is taken by the majority of the population. And to date, there's a significant amount of people that would not take the vaccine. And then at that point, maybe consumer sentiment comes back in those industries that people were fearful about. So there's kind of a long-winded way of saying that in a lot of those COVID-19 impacted businesses, it's because of liquidity issues that I don't think, that precipitated the catalyst and why I got involved in the situation. And I don't think that announcement of the vaccine or even a rollout of the vaccine is going to help the company, in the next 6 months, which is really kind of the critical time period where we have to kind of get to a solution.
Yeah, that is an interesting point. It's really, there could be a vaccine, but a lot of these companies, they need liquidity and they need a fix, not in 24 months. They need a turnaround in their business and their either capital structure or their operating structure, way before that. I know we only have a few minutes left. I wanted to just kind of take everyone's view on one question. I think we have a bunch of students from YU on the line, and maybe some younger professionals who may not be in Wall Street or, in the distressed or credit world, who may want to be one day. So I thought maybe I'd just kind of ask everyone the same question, and then we can open it up if there's any more time. But maybe I'll start with Josh, Brody. Any advice for current students or any younger professionals who want to get into the distressed bankruptcy world, whether it's counsel and on the legal side or just in general? You have?
Well, I guess if you want to go to the legal side, I guess I'd advise going to law school is probably a good first step.
Pretty practical, yeah.
Yeah, exactly. Yeah, I mean, look, from my perspective, it's the lawyers always want to be the hedge fund guys. The hedge fund guys, actually, I say everyone wants to be the hedge fund guys. Even Matt, I think even the bankers want to be the hedge fund guys, right? On the legal side, look, I was drawn to when I started law school because I just thought it was a cool idea of fixing broken companies. And I learned that being on the creditor side is even more fun. But the only thing I would say is, in a legal perspective, is getting big debtor experience is definitely a good place to start. That's what I started doing. I get the broadest experience there. So on the legal side, I think that's probably what I would tell people.
Okay, great. And Simon, I know we've shared many conversations when we were kind of sophomores and juniors, and I always looked up to you as 1 year older, but very active in trying to get that really solid interview with various different either sell side distress desks or the buy side. And what advice would you have for any current students or younger guys in the field?
Sure, and those were some good times too.
Yeah, simpler times also.
I think there's obviously the givens where it is having the right grades, doing the good internships, networking, preparing for interviews. I think those were largely givens, but just making sure you find this interesting and a job that you truly enjoy and you're passionate about. And because there are a lot of fun parts of joining restructuring committees, but you also spend a lot of time doing credit documents and going through org charts, just making sure that this is something you're passionate about. And the best way to do that is through internships and getting to meet with people. And I think if you decide investing in distressed debt is your passion, I think one of the best ways to get into the field is having real tangible experience so you can look to add value day one. And for example, I think one of the most traditional paths for our incoming associate class is from restructuring banks. So PJT, Perella, Julian Loki, Lazard, Evercore, because there you'll receive real tangible experience and you can add value day one. So it makes you a much more of an attractive candidate.
Okay, great. Matt, what about you? What about from the restructuring side and restructuring go? I know you talk to a lot of kind of younger guys in the field, and we've also shared many conversations about this.
Yeah, I think really Simon hit it on the head. I say this kind of as a joke, but also not as a joke. But if you're not reading restructuring stuff, while you're in the bathroom, then there's a problem. But what I'm really trying to say, what I really mean when I say that is, you got to be thinking about this all the time. You got to be focused on this industry constantly and be interested enough in the industry that you are reading about it in the bathroom. Because if you're not doing it, someone else is. It's a large asset class, but a small industry, and a lot of people, the people that are in it, I think, are all incredibly passionate about it. And so one of the first things I do when I'm doing an interview, early on, is I'll ask the candidate, so what is something that really interests you right now in the restructuring landscape? Tell me about some theme. Tell me about something that you've been reading about, that you've been thinking about. And if they don't have anything, I know this is probably not right for them, because you would be surprised. We do have sophomores and juniors and undergrad that when I ask them that question, they have a list of 10 things. That's kind of the feedback that I give for people when they call me and they say, what do I need to do to be ready for this? What do I need to do to kind of showcase myself? And it's like, if it's really true, then you'll be able to show your passion. And I think that's the most important thing.
Okay, I totally agree. I remember one of my first interviews when I was at Citi, coming out of YU. Interview for Citi was, I think the interviewer asked me, give me 5 topics from the Wall Street Journal, the finance section that you've read over the last week or two, and just kind of walk me through each of them. And you have to really be on your toes, and you got to be reading, you got to be interested in it. My view is you have to really have kind of a trade idea ready to go. And that just kind of really implies that you were reading and thoughtful and thinking kind of holistically about a topic or a company or an industry. Ian, just end off with you on this. Any advice that you have for any of the younger people on the phone?
Yeah, sure. So I think I'd echo what Simon said, which is you really have to like it to do it. It's not easy work. People work extraordinarily hard. As Josh said, with the fratricide, it's a very competitive industry, and to do the work, takes putting in the time, and you're really not going to enjoy yourself if you don't, if you don't find it interesting and you're not passionate about it. And, it's hard to know whether you're passionate about it without knowing about it. And so, one thing that I found helpful was, speaking to mentors, over time, really starting in undergrad and, through my banking experience, there's many people, I went to Penn, there's many people, in, my network. There's certainly, a number of people in this industry in the YU network that you can reach out to, that, because of experiences that they had from mentors, will likely be more than happy to sort of walk you through, the industry and what the job's like on a day-to-day basis. And so, learning about it, especially, through informal mentors, is a great way to understand whether this is something you want to devote time to. And, to the extent it is, getting a taste of it in a banking program is certainly a great first step.
Okay, great. Lawrence, Eliza, I think we're up on time. Do you guys want to take it from here?
Yeah, maybe I'll start off. I'm going to follow up on exactly where the theme was that you ended with, which was mentorship. And to Ian's point about the YU community, Ian, you went to Penn, but you're part of the YU community too. These events are here. We really do want to create a big community to help the YU students. Professor Ravid was talking about it beforehand. There are many ways of helping the students. You can be an adjunct professor. There are ways to get involved. The students really will appreciate you mentoring them, trying to come up with an internship opportunity. And everybody here should feel part of that and welcome to be part of it. I'm going to mention one little commercial over here before I hand it to Eliza, which is these events are normally held at noon Eastern time. We do that so people in Israel can join and people on the West Coast can join. We had a great over 80 people showing up at 7:30. Please send us feedback if you prefer the evening. We can switch things to the evening as we start planning 2021. So we'll be dynamic and try to be flexible with what works in people's schedules. So Josh, Ian, Simon, Matt, and Josh, thank you so much for giving your time and insights to the YU community. And we really appreciate it. I want to hand it off to Jake and Eliza from the Office of Alumni Affairs, who help assemble and put all of this together. So Eliza, I give it to you.
Thank you so much. We'll just take one more minute of everyone's time. Thank you so much to all the panelists. It was really interesting. And this is totally not my field, but I definitely learned from all of you. So I really appreciate it. And I just want to let everyone know that we have events coming up, first of all, every Wednesday till the end of the year, which is really exciting. So if you want to join us for all of them, please do. In addition, we actually have two events that I want to bring your attention to. December 6th is the annual YU Hanukkah dinner. Please keep an eye out for that email or invitation. It's going to be a night of 1,000 dinners because everyone's going to be remote in their own homes. It's going to be really wonderful. And the other thing that I wanted to share is that we have an exciting virtual wine tasting coming up on December 15th. It's going to be on Hanukkah. So keep an eye out for those emails as well. You'll place an order and the wine will be shipped to your home. And we're going to be having some really cool wineries representing with the owners and talking about the wines. And it's just going to be a fun night. So be in touch if you have any ideas or programs you'd like to see. And we really are so appreciative of all of you joining us. So thank you all so much and have a wonderful night. Bye-bye.
Bye, everyone. Thanks.
Bye. Thank you very much, everyone.
Thank you.
That's great.
Bye-bye. Thank you very, very much.